cash transactions in India are subject to various regulations and limits. While there's no specific limit on how much cash you can hold, it's crucial to understand the rules to stay compliant with tax laws. Let's start with cash holdings. Indian income tax laws don't stipulate a specific limit for the amount of cash you can keep. However, if tax officials conduct a raid, you must be able to explain the source of your cash. It's essential to keep records of transactions to show where the money came from. Unaccounted cash can be seized by tax officials, and penalties of up to 137% of the seized amount can be levied. Now let's look at the main cash transaction limits in India. Section 269 SS restricts accepting loans or deposits of more than 20,000 rupees in cash. Section 269 T limits cash repayments of loans or deposits to the same amount. Section 269 ST prohibits receiving more than 200,000 rupees in cash for a single transaction in a day from one person or for transactions related to one event. These limits apply to various scenarios. For example, you can't accept a cash loan of over 20,000 rupees or repay such a loan in cash. Similarly, you can't receive more than 200,000 rupees in cash for a single transaction or from one person in a day. The government has also implemented TDS, or tax deducted at source, on large cash withdrawals. Banks, cooperative banks, and post offices must deduct tax when cash withdrawals exceed certain limits. The rate is 2% for withdrawals over 1 crore rupees, or 3 crores for cooperative societies. This rate increases to 5% for higher amounts, or if the person has not filed income tax returns for the past 3 years. Certain cash transactions attract the attention of the income tax department. These include cash deposits of 10 lakh rupees or more for bank fixed deposits, cash payments of 1 lakh rupees or more toward credit cards, and cash deposits or withdrawals exceeding 10 lakh rupees for savings accounts or 50 lakh rupees for current accounts. Some cash transactions are outright prohibited or have strict limits. For instance, cash payments exceeding 10,000 rupees for business expenses are not allowed as deductions under Section 48(3) of the Income Tax Act. This limit is 35,000 rupees for expenses related to goods carriages. Understanding and complying with these rules is crucial for individuals and businesses in India. Always keep proper records of your cash transactions and their sources. When in doubt, it's best to use electronic payment methods or account payee checks for large transactions. This not only ensures compliance with tax laws, but also contributes to the government's efforts to move towards a more transparent, cashless economy.